Good day, junior techies. I'm Mrs. Brimacombe. We're going to look now at activity 2. A reminder before we start with this activity. Make sure that you go through the accounting theory booklet before you attempt any of these questions. It is very important for you to understand the terminology. Question 2.1. Define the following terms. So if we look at the term capital, the term capital, this is cash or other assets provided by the owner in order to start the business. Whenever you start your own business, you need money, you need capital. So the owner will provide the capital. It represents the investment made by the business. You are investing in your own business. Drawings, the money and goods that the owner takes for himself from the business for his or own personal use. Again, we apply the business entity principle. Anything that the owner takes for personal use must be shown as drawings. It is not a business expense. If the owner pays for his own personal insurance, for his own personal telephone account, it's not a business expense. It's a personal expense and must be shown as drawings. When we look at owner's equity, this is the interest that the owner has in the business. Income, this is the money that the business receives during the accounting period. And when we talk about the accounting period, an accounting period is equivalent to 12 months. It can start from January to December, or it can start on the 1st of March and it ends, for example, 28 February. So an accounting period is always equivalent to 12 months. Expenses, these are items that has no lasting value. It will never be recovered. Cost incurred directly or indirectly so that the business can carry on with its activities. And if we look at a few examples, we need to pay our employees their monthly salary, their weekly wages. We need to pay our telephone expense, our telephone account. We need to pay our insurance. This is cost that incurred in the business so that we can keep the business running and operating. When we're talking about assets, we're talking about possessions that the business owns. Liabilities is money that the business owes to outsiders. So if we look at, we said owner's equity is the interest that the owner has in the business. So the three concepts that make up the owner's net worth is capital, drawings, and the profit or the loss that the business makes. And when we're talking about net profit or we're talking about net loss, we are talking about if we look at all our income minus all our expenses. If our income exceeds our expenses, the business made a profit. But if our income is less than our expenses, it means that the business made a loss. This can be illustrated on a T account, and it's so important that you understand it. If we look at owner's equity, it consists out of capital and drawings. The owner's equity will always decrease on the debit side. The left-hand side is called the debit side. The right-hand side of the T account is called the credit side. So on the debit side, it will decrease. On the credit side, it will increase. And this is important to understand because if we look at capital, the capital will increase the owner's equity. But the more the owner takes from the business will decrease the owner's equity. And then we say that all income and expenses has an effect on the owner's equity. And why does it have an effect? Because income minus expenses equals profit, and the profit will increase the owner's equity. If we look at income minus expenses and our expenses is more than our income, it means that the business made a loss. That will decrease the owner's equity. Again, it is so important to understand. And to go a little bit further, we talk about Direct and indirect owner's equity account. So when we're talking about direct, we're talking about capital and drawings. Indirect, we're talking about all income and all expenses. Why? It has an effect on the owner's equity. We said earlier that assets is all the possessions that the owner owns. But now we're going to delve a little bit further into it. You need to understand that there's long-term and short-term assets, and the same as with liabilities. Liabilities means that the business owes money to. And again, we're talking about long-term and short-term. So that's why it is important to understand, but what is the difference between non-current assets and current assets? What is the difference between non-current liabilities and current liabilities? If we look at non-current assets, we're looking at items with a long life that the business bought with no intention to sell it. That will stay in the business for more than 12 months. So they are going to use those assets to generate an additional income. But when we're talking about current assets, it's cash or possessions that can be converted into cash within 12 months. Those are things like our trading stock. Trading stock is a current asset, and we're going to sell that asset, not over 12 months, longer than 12 months, but less than 12 months. If we're talking about non-current liabilities, we're talking about debt that will be paid off over more than 12 months. Current liabilities is debt that will be paid off less than 12 months. So it's important to understand, irrelevant if we're talking about assets or liabilities. Non-current means long-term. Current means short-term. Once you understand what is the difference between non-current and current, we're going to look now at 3 non-current assets, and we're going to give a definition of each one of them. So the first one is land and buildings. These are premises bought for running the business. Vehicles. Vehicles are purchased by the business and it's used to generate additional income. Equipment. Items need to run the business. We need a cash register. We need computers. We need furniture. All of these will be regarded as equipment. Your non-current assets will always consist out of these 3 items. So make sure that you study them. If we look at 6 current assets and we need to give a definition of each one of them, remember that when we're talking about current assets, we're talking about short-term assets. It's less than 12 months. It can be quickly converted into cash. So the first one is we need a bank account. Cash that the business has in their current account. All money is deposited into the business current bank account and all payments are made from the business current account. You cannot run a business or start a business without having a bank account. The second is cash float. We need to give our customers change. So money is kept in a cash register to give change to the customers. But now you should not get confused with what is the difference between cash float and cash register. When we're talking about cash register, that will form part of my equipment, my non-current assets, my long-term assets. But the money that we put into that cash register is called our cash float. And that is for us to be able to give change to the customers. Then we need petty cash. Now, petty cash is cash kept aside to pay out for small amounts like milk and sugar. These are just examples. So you will have a box, which will be called our petty cash box. And inside of that box, we are going to put cash that we will use for small things that we need to pay for. Then, savings account. It means that we have extra money. So what can we do with that money? We can put that money and transfer it from our business current account, and we can put that money into a savings account. A savings account normally generates more interest than a current account. Trading stock. And this is applicable not to a service business, but a trading business. When we're looking at a trading business, it means that we are buying from and we are selling to. So we are buying, for example, if we have a stationery shop, we would buy stationery, and that stationery would be our trading stock, which we will sell to customers. Our aim is to make money, so we would sell it at a higher price than what it cost us. Then the last current asset is debtors control. And debtors control refers to people who owes us money. When you refer to the accounting cycle, you will see that the first step in the accounting cycle is that a transaction should take place. Now, in accounting, it is very important to understand that in each transaction, you need to identify which account is involved. When we talk about account, we're talking about which is the name of the business account. So if we look at the first transaction, the owner gives further capital contribution. The business name that is involved, the business account name, is called capital. Purchase a new set of pens. Now, we're not going to show this as set of pens. This will be regarded as stationery. Purchase tables and chairs. Tables and chairs is regarded as equipment. And that's why it is so important that you understand the definitions of these words, because otherwise you're going to find this difficult. Where should I actually place it? Bought the owner a new Samsung cell phone. Now, when it talks about the owner that's got a new cell phone, it means this will be shown as drawings. Anything that the owner takes for personal use is shown as drawings. Paid employees their weekly earnings. Weekly earnings is regarded in accounting as wages. Paid the owner's personal telephone account. Again, this talks about personal telephone account. This is shown as drawings. Paid for marketing pamphlets. Marketing pamphlets will be regarded as advertising. So this will be an advertising, an expense to the business. Received cash for work done for customers. So the business received money because we've done work for customers. We have rendered a service. This is regarded as fee income or as current income. Paid to have the business car repaired. So when we're talking about the business car, it doesn't say that we've purchased a new vehicle, a new car. We've had this repaired. This means this will be shown as repairs. Purchase a new delivery van. Now we're talking about vehicles. Paid our managers their monthly earnings. Monthly earnings is regarded as salaries. Purchase a new laptop. We're not going to show it as laptops. This will be shown as part of our equipment. Earn interest on a fixed deposit account. So this means that the business has invested money by putting money into a fixed deposit. And now it's said that we've earned interest. That means this will be shown as interest, and now we need to be specific. What interest did we earn? And that's why you have to say interest on fixed deposit. Purchase taps for the staff bathroom. This will be regarded as equipment. Received money from the tenant. So number one, the business received money, and when it talks about tenant, this will be shown as rent income. You cannot show it as rent only. You must have rent income, because just as the business can rent out premises, we can also be renting from other businesses. or other people, and that will be shown as rent expense. And this is the next example, pay the monthly rent. That will be shown as rent expense. So make sure that you are specific. Received money from services rendered on behalf of another business. So here you need to be careful. When we look at a service business, it means that we're rendering services, and our main income from that is called fee income or current income. But when it says that we've rendered a service on behalf of another business, we will show this as commission income. And again, you need to be specific, because the next one said paid commission to sales staff. This means I've got employees and they will earn commission based on their sales. And that will be an expense to the business. It won't be shown as salaries. It won't be shown as wages. This will be shown as commission expense. Paid for cleaning materials to clean the offices. So if we buy cleaning materials to clean the offices, this is regarded as consumable stores. Anything that we consume in our business. Not for the purpose of reselling, but we are using it in our business. Like cleaning materials is consumable stores. Paid a deposit on a new building. So this means that we are purchasing new buildings that will be regarded as land and buildings. Once you've identified the business bank account, it is very important that you classify each account as either an asset, owner's equity, income, expense, or liability. So this question will focus on identifying the business account name and classifying that as either one of those 5. So if we look at the first one, debtors control. Debtors control is regarded as an asset. And to go even a little bit further, although this was not required, debtors control is a current asset, a short-term asset. Bank overdraft means that we owe money to the bank, and that will be regarded as a liability or classified as a liability. And again, to be specific on this, when we're talking about bank overdraft, the money is paid back immediately. That's why it will be regarded as a current liability. Interest on bank overdraft means that we have to pay interest for borrowing money. So that interest is regarded as an expense to the business. Bank is an asset, and to be specific, it's a short-term asset, so it will be regarded as a current asset. Interest on current account is when you have money in your bank account. You can earn interest for having money in your bank account. That is an income to the business. Salary is an expense. Fee income, the word says that, income will be regarded as an income. Packing materials, an expense to the business. Trading stock is an asset. And again, to be specific, remember what you've learned earlier. Trading stock forms part of your short-term assets, which means current asset. Water and electricity is a monthly expense, so this is regarded as an expense. Drawings will affect the owner's equity. It is an owner's equity account. And to go even further, this would be regarded as a direct owner's equity account. Loan, ABC Bank, it means that we have borrowed money and we owe money to ABC Bank, and that is regarded as a liability. Again, can you see why it's important to understand the definitions of each one of them? And when we're talking about a loan, this is regarded as long-term, non-current liabilities. So when you borrow money from the bank, they are going to charge you interest, and that interest that you pay will be regarded as an expense to the business. Fixed deposit, Century Bank. Can you see that when we have a fixed deposit, we need to write the name of the bank, from who or where did we invest our money, And the same as with loan, from who did we borrow money? So the name must be written. Now, a fixed deposit means that we've invested money in a long-term asset. That's why it is an asset and it's regarded as a non-current asset. So why would you invest money? It's because we're going to generate an income from that, and that is called interest. And you have to be specific. Interest on fixed deposit. That is an income to the business. Savings account means that we've transferred money from our bank account and we've put it away in a savings account. That savings account, we will have immediate access to that. It's regarded as an asset, and because we have immediate access to that account, that is short term, it is a current asset. And what do we generate from that? We generate interest on the savings account, which is regarded as an income. Again, we have drawings. Drawings, remember, it's an owner's equity account. It is money that the owner has taken from the business. In fact, anything that the owner takes from the business will be shown as drawings. Telephone, a monthly expense to the business, so it's regarded as expense. Wages is what we pay our employees on a weekly basis, which is regarded as an expense. Commission income is an income. Consumable stores is an expense. It's things like we say cleaning materials which we consume in the business. Do not confuse consumable stores with assets. Sales is an income to the business, and this is more related to a trading business. And cost of sales is a non-cash item. It is an expense to the business. Thank you very much. I hope from this activity that you have a better understanding of the terminology. Please remember, it is important that in each transaction, you need to identify what is the business account name. In other words, as what are we going to record it in our books? And then it is so important for you to understand that each business account must be classified as either an asset, an owner's equity, an income, an expense, or liability. Because if you do not understand that, it's going to be difficult when we go to the next step, the next phase, by identifying the influence of each transaction on the accounting equation. I want to leave you with the following quote: "Nothing is impossible. The word itself says, I'm possible." Thank you. Have a wonderful day.